Jito, is it recording?
Yes, it is.
Okay. Hi guys, once again a very warm welcome for this today's event with Project Possible 2022, and we are very much happy. Is it recording?
Yes, it is.
And is very much happy to
Hi
see.
guys.
Once again, a very warm welcome for this today's event with Project Possible 2022. One second, I just think it's getting complicated.
Yes, it is.
And is very much happy to
Hi
see.
guys.
Sorry guys, I hope you are able to hear me.
Yes, Rob.
Yeah, sorry for that interruption. Thanks once again for everyone to join this very good evening, and welcome to the Project Possible. And we are very much delighted to introduce our guest for this evening. Before that, I'll take you through few important rules that we need to follow while we are on this. Everyone is on the call. So, as we say, while we are on this particular live event, I may request everyone to keep your cell phone on silent mode and mute your mic unless if you are speaking, and you do unmute yourself, and while we have a Q&A session, it's you can unmute it and proceed with the session. Make sure that you switch on your videos, as for it's very user friendly to understand who is asking what questions, and it will be more interactive session rather than one more session. When you switch on your videos, that will be great. Also, please make notes of the points that our guest will be putting across in our table this evening, which will be benefiting for most of us who is very much a newbie to the property industry. Any questions you have, please post it in the chat box, and we will pick it up from there and put it across during our Q&A session. By any chance, by any means, if your internet stops working or any other technical issues, please use the same user ID login details to join in, and we will be back. We will be available on the same meeting ID. We have some. The other thing is that we have a referral. We have a Trustpilot scheme where you will share your feedbacks to us, and that will be very much important in us to cater you with more information in coming days with the queries that you raise after this particular session. So nothing much to add from this side. From the rules, I'm handing over to Jito for taking it forward.
Thank you, Robin. And once again, welcome to Project Possible. And I'm sure like you all have taken effort to be with us this evening, and we got a special guest with us. And before I could say anything about our guest, this one quote comes to my mind when I think of John, that we find a purpose in life and then you run with that purpose. And that's exactly where I think about John. He started his career, went into data analyst, and then he found his passion into property, and using his skill, which God has given him about data and analyzing, and brought that skill into property. And now not only that, he has developed it over the years, and now he's trying to make that as a useful way. I don't want to kind of take away the mystery and like things which he's going to share, but he has developed such a good way of sharing. Anyone can benefit from that platform. And that's what I have said. And it's such a user-friendly way of bringing data and property together and helping any ordinary person who wants to be successful, who has a passion to do it. So that's how I see John, who has really utilized his skills, his knowledge, experience, and brought it for each one of us. So we are humbled to have John with us this evening. John was our first expert for this year in Jan. And at that stage, this software, this application was just at an early stage. But John gave us a very good insight about how property market works and how data can help us to analyze and kind of keep our emotions away while making decisions. But now John has gone really further. Like, in fact, John was saying before the catch up, this year has been like we did so much. It's like 10 years of work. So he has a lot to share with us in the next 60 minutes. So make sure you make ample of notes. There's a lot of positivity what John is going to share, not what you hear from the media, not the scary stuff. He's going to share something where you can really hold yourself and take one step at a time towards your property journey. And he will not only just share his knowledge, but he will also provide you with the tools to take those steps. I meet a lot of people who just come and say a lot of things, but they will never give you a genuine support. But knowing John, he has worked, he has invested a lot of his time, effort, money, resource to build those tools, what he's going to share with us. So on that note, John, this is over to you, John. Thank you.
Thank you very much, Tom. What an introduction. I don't really know how to follow that, but thank you again for inviting me to present again this year and to help you and everybody that's listening to this presentation to frankly make more money and make sure that you are as successful in your business and also in your personal lives as you can possibly be when it comes to investing in property. That's something I'm very passionate about because insight and in having an insight into what's likely to happen next frees us up to make more informed and better decisions as property investors. Certainly something that I've seen in my life and in my business journeys, and also the businesses of many others, particularly successful investing business and property businesses. They tend to fall into the category of being more insightful. So that's really the context and the content of this evening's presentation. I am going to cover an awful lot of information, and it is going to be at quite a pace. So apologies in advance, but you will get, as I understand, an opportunity to ask questions and for me to try and answer them at the end. So we will rattle on at a pace, but it's probably worthwhile introducing myself and giving you a bit more detail about me very briefly. So I am a property investor in the UK. I invest in a few different locations around the UK, and I also consult with businesses that are also investing, small and large. I provide consultancy and mentoring services to those investment businesses. I am an active investor, so I still am buying properties. I've bought not as many as I would like to have this year, but I've bought several properties this year, and I intend to continue buying properties and investing in properties in the coming months. I'm based in Wales, which is in the sort of western part of the UK. It rains a lot, but it's quite nice when it isn't raining, and I enjoy spending time with my family, and I quite like being outdoors as well. So that's a little bit about me. And as Jito has mentioned, I am a little bit obsessed with numbers and a little bit obsessed with data, and I don't make any apology for that, because throughout my career and throughout my investing journey, I've used data and I've used numbers and used facts to invest, and I found that that's a lot better than trying to work out what to do without facts, or worse still, just doing what someone else tells you to do, because sometimes they get it wrong, sometimes they're making it up, and we're gonna cover that this evening. Now, just a quick disclaimer: if this matters to you, this is going to be important. It's not financial advice that I'm giving tonight. If you want financial advice, speak to a financial advisor. If you're going for mortgages and credit products, speak to a financial conduct authority, authorized mortgage broker or advisor. And most important is that last point: do your homework, trust the data that you gather and the facts that you gather. Don't take other people's facts as facts, because sometimes they are not. So just because I'm sat here talking to you this evening doesn't necessarily mean that what I say is right for you and your business. So just be aware of that, and I won't dwell on it any longer. Now, the UK property market at the moment, there's a particular number that matters to us, and everybody has a number or a quote, or the media has something to publish every single day at the moment. But a really important number for us is 49%. 49% is a critical number for us, because this number is really significant. This number is really significant for us as property investors, because the UK property market has seen massive change since 2019, since pre-COVID. And one of the major changes has been the fall in availability of rented properties, private rented properties. The number of properties listed for rent on average has fallen 49% between March 2019 and March 2022. So that's transformational. That's the reason why the market is very stressed. That's the reason why tenants are getting very upset, because they can't find properties, why rents are going up. It's not because of greedy landlords or because of issues externally. It's simply down to the fact that there isn't enough supply. Okay, there's not enough supply. So there is still a demand for people like ourselves to invest in properties and create those properties that are suitable for the rented market. I know a lot of us will be looking to buy properties to rent them out. And even if you're not, even if you're looking to sell them on, this figure is still important, because it just kind of demonstrates the lack of availability of property in the marketplace at the moment. And that type of number and that type of insight is what matters. It's not about what the media publishes or what you read on Facebook. It's what you understand from the data that's available to us. And this data is all around us, and you've kind of got a choice. You can try and work it out yourself, or you can use products and services and software to enable you to get to the insight, the decision that you need to take. So with that previous slide, the 49%, I know that with pretty high level of confidence that the rental market is very buoyant and it's unlikely to fall back because there just isn't enough supply. So that's the insight that I get, and that then informs my investment strategy to continue to invest in rental properties, which is what I do. And that's just one example. Now, a lot of what I cover off this evening is going to be available to you, and Jita did mention it very kindly a moment ago. I have worked this year to create a software platform to help you with a lot of this stuff, and don't rush to do it just yet, because I'll come back to it later. But there is a special offer for you this evening where you can get access to this information and also get a little thank you from me as well. Now, the property industry, as I see it in the UK, is very much a bit like Trotters Independent Traders, which is a quirky program that was around in the 1980s and 1990s on British TV. And these two young brothers were trying to trade. They were wheeling and dealing and trying to get great deals on and basically make themselves millionaires. So they were entrepreneurial. They were trying to do the right thing, but they were kind of getting it wrong all of the time, because they were just doing things on a hunch, not necessarily thinking about what they were doing and not planning. And I find our industry a little bit like that, because in any other investment market, in most other industries, you have lots and lots of insight, lots of analysts, lots of data, lots of knowledge, and most decisions are only ever taken based upon someone's analysis and research. And yet for us, we spend hundreds of thousands, sometimes millions of pounds of our money or someone else's money without having a clue or even bothering to look at where the market is going in a particular area. And if we do try and bother, the information isn't necessarily relevant to us, because we just don't have that concise and sort of readable information. And that's odd. That's something that I found odd, because I came from a background like this, where there's lots of decisions being made by clever analysts and lots of advice being made by clever analysts. And I went into a market where similar sums of money were being exchanged and transacted, but people were just doing it on a hunch or because somebody told them to do so. And that's very dangerous in my view, because frankly, not everybody's looking out for you in the property industry. And particularly in the UK, there have been some real scary stories recently about investments that have gone wrong, some companies that have encouraged people to invest in bad things, and such, and so on and so on. So don't for one moment think that you're the person you're talking to is going to look out for you, because they won't a lot of the time. And I learned this in retail, because my first part of my career, corporate career, I worked in the food industry, in the drinks industry, and I worked in retail. So I worked in Lidl out of university, and I learned how to manage teams. I went to Summerfield for a little while, learned about project management. I went to Spar, and I was encouraged to move into procurement. So I was trained to negotiate, and then I imported and traded products for Spar in the UK and a little bit of European trade as well. And then I worked for a small startup company called Sales Out, which got absorbed into IRI. I was headhunted by Sales Out because they wanted someone who understood how to use data to negotiate. So that was my USP. And then I encouraged that business to grow and provide services to lots and lots of multinational companies, Coca-Cola, GSK, yeah, PepsiCo, you name a brand, I've probably done some work with them through IRI, which is the second largest data company on the planet for food and retail. So that was my corporate career. And a lot of what I learned there, I transitioned into my embryonic property business. I knew lots of things. I had lots of skills and techniques, and I wanted to incorporate that into my property business because I did not want to take risk. And risk is something that you absolutely need to avoid in business because it'll bite you. We have to take educated risk. We have to push ourselves outside of our comfort zones, but we can't just blindly run into something that we don't understand. We manage risk through the availability of insight and facts. So for me, that's something that was lacking in the industry, and I sought to do for myself initially. And as time went on, I've done it for other people, culminating in Ultimate Property Dashboard. Now, I have another couple of businesses. I've got Ultimate Landlord Research. So we do research for government and we do consultancy work for property investment companies. I've also written a book because apparently if you're gonna do well in the property industry, you need to think about writing a book. So I thought about it for a long time, and then during COVID, I wrote it. I also do market reads. I also am a guest writer in a few magazines, but most importantly, I'm a property investor. Still am. Still working on it. That's my passion. That's what I really enjoy doing. And I use the skills and experiences that I gain in data to inform my property investing journey. And when I invest well with data, I can share that back to other people and show you how I've done it. So that's a little bit about me. I've got to stop talking about me, really. What I do want to get back to is insight. Now, insight for me in our industry, we've got two elements. We've got we've got a bit of a typo there. We've got opinions and experience on the left-hand side, the red, and then we've got evidence and data on the right-hand side. So experience and opinions, and then evidence and data. We've got loads of this red side, loads of this qualitative information. People with an opinion. I think the property market's going to crash. I think the property market's going to go up 10%. I think you should invest in Manchester. I think you should invest in Swindon. We get a lot of that in our industry. What we don't have is the quantitative side. This is how much Manchester has grown over the last 6 months. This is the type of property that you should be buying in Swindon. This is the yield you can expect to get in 6 months' time on a flat in Bristol. So these are the things that we lack. We don't have access, or we didn't have access to that information. And that's really quite worrying, isn't it? Because we are investing our savings, which we will have worked for many years and very hard to accumulate. We are taking on debt. We may be taking mortgages. We're doing all of this scary stuff without necessarily knowing anything about the market into which we're investing. We just understand the specifics about the mechanics of buying properties, and that's a little bit scary for me, because when I was very young, I saw this happen in a different way. I saw what happened in my childhood. We grew up in a council estate in an area. That council estate started to get a bit rough, and it was recommended that we move to another part of town. And when we moved to that other part of town, it didn't necessarily make us that happy, and it didn't make me, my family, my mum, my brother, it didn't really deliver for us. It didn't give us a great outcome. It was a bit embarrassing. The property was a bit poor quality. The landlord wasn't overly keen to fix things or to make it nice. It was very, very poor quality property, and it was the worst property in the best area. It wasn't dreadful, but it wasn't the best. But the situation we found ourselves in was not what we wanted, or what my mum wanted, and she'd asked friends and family for that advice, and the outcome wasn't right. And aligning what you want with what can be achieved is kind of important in life, and it's very important in property, because if you get it wrong, there really are some great pitfalls. So we've got to look at what's going on around us, the reality of what's going on at the moment. So sentiment means you've got to be careful. You've got to be aware of the media. You've got to be aware of Bank of England guidance and comment. You've got to look behind the headlines, check they're working out, and not confuse scale and celebrity of accuracy. So the Bank of England so far this week has changed its mind 3 times on what it's going to do with some of the issues in the pension sector. So if you took their advice and listened to them on Wednesday, on Monday, it would be very different on Tuesday, and then it's very different on Wednesday. It's probably going to be different by the end of the week. So we've got to be aware of this. This sort of stuff is going on all of the time, and I won't make an apology for repeating what I covered a little bit earlier this year in my first presentation to the group. Remember, in COVID, in May in 2020, as we emerged from lockdown, the Bank of England predicted a 16% decline in the property market, and a leading estate agent predicted that house prices would fall 7%. That was in May. Okay, big estate agent and the Bank of England. By the time we get to September, which is just a few weeks, really, when you think about it, we suddenly looking back and saying, oh, hang on a second, house prices didn't fall. They actually surged to an all-time high. And that's because people and our industry don't use data effectively. We don't understand what's going on. It's not just me and you and anyone else that happens to invest in property. It's the major institutions, even the Bank of England and some of the biggest estate agents still can't forecast just a few weeks ahead. So that's terrifying when you think about the sums of money that are involved. And I seek to change that. I think, we all need to seek to change that. Again, not just one publication. There's another one, 7th of May, it's going to collapse. And then by the beginning of August, the Bank of England is telling us that the property market's returning to close to normal levels. So, this nonsense, this noise is dangerous. We know, and I don't need to tell you what happened to property prices as we went through 2020 into 2021. Property values surged. We saw some of the highest growth in the last 10 years over the course of the end of 2020 and through 2021 and even into 2022. We've had massive house price growth in the UK. And yet our major institutions were forecasting that it wouldn't happen. We were actually forecasting the reverse. They're getting it really wrong. So, I see these cycles, and you'll see this repeating itself again. Look at the media. A couple of weeks ago, this screenshot is, and apologies, it won't come out brilliantly if you're on a small screen. But what we've basically got here is me on YouTube searching property market. That's all I did. And the main headlines that I get are property market news, which is fine. We've got that. And then we've got the UK property market faces correction, risk on prices, 8 reasons house prices will collapse, housing market collapse just got worse, how UK interest rates set to double, market crash imminent, property prices are collapsing, and the housing market is starting to crash 2008 style. So, once again, we see a repeat. Is the property market going to crash? That is the question. I didn't even ask that question. That's the question on most people's lips at the moment. And everybody who wants to pretend to be an expert is saying, yeah, it will. And they give you all of the reasons under the sun why the property market is likely to crash. What they don't give you any balance. They don't look at some of the reasons why properties may not crash, why properties may not fall in value. They forget that because it's just more exciting and it's a bit more of a hook to get you talking about a property market crash. And again, history repeats itself. This is not something that's new. This constantly happens. And frankly, back in 2007, 2008, when we were about to have a housing market crash in the UK, most people were saying the housing market was going to continue to grow and it's great and you've got to put your money in. So, I remember that because I was still an investor at the time, but a lot of people weren't, and I've not seen the mistakes that all of these pundits will make. I certainly have. So my advice to you is just don't listen to them, please. Ignore it. Do your own homework. Now, the opinion versus the reality, there's a producer price index, and this is probably one of the most important measures. And I have talked about this in a few of my presentations, but this is really important right now for us. So the producer price index is a measure that we can get in the UK. And what that tells me is input costs fell marginally in August, and output costs also fell marginally in August. So to date, we've had massive pressures on inflation. We know that. That's the big critical thing. Is the reason why the Bank of England is putting interest rates up. But actually, the Bank of England is putting interest rates up, but the market's already started to calm just slightly. It has grown an awful lot. The inflationary pressures have gone up an awful lot, but they are starting to plateau now, and you can see that there. Now, input and output prices are relevant, and I'm gonna come back to these in a moment. to really explain the fundamental reason why we shouldn't be looking at the retail prices index or the CPI. We should be looking at the producers price index. But before we do, I just want to make some sort of key thing, or talk to you about some of the things that are relevant at the moment. Inflation's very high at the moment, and it's near record levels. And the delay on RPI measures means that there is likely to be more reports of high inflation until December. So although those figures that I showed you a moment ago in terms of the input and output prices are steadying, they won't be seen in data in the RPI or the CPI measures until at least December. And there are other things that are driving up costs as well. And oil and agricultural products are the only real things at the moment that are holding back inflation. And oil is just about to start climbing again. And agriculture, well, once again, we've got a bit of a CO2 issue in the country. So the final bit in this equation is interest rates are likely to continue to increase input costs, but that'll come later on. So we're in an inflation cycle. It's going to continue. It's going to get a little bit better toward the tail end of this year, but then it's going to start climbing again. Now, the Bank of England may see that slowing down of inflation later on in the year and actually peg interest rates a little bit and maybe even bring them back down again. We don't know that yet, but that's what's likely to happen. So that's what we know at the moment. But there's more important information to go with as well. The UK house prices, the house price growth continues to be strong, and it actually has been outperforming inflation. So you can see that the Land Registry sold prices, rolling 12-month house price, and then if you look that particular, it shows you how much is 12 months to a point versus 12 months a year ago. Where we can get a little bit more interesting and a little bit more accurate is the rolling 1 month. So how much is it increasing on a sort of month by month basis? And you can see right up until the end of July and August, we had massively growing housing market. So you could argue that there was a need to put something in place to slow it down a bit before it got even more out of control. So bear in mind that over the summer, UK property sales rose, or the demand for UK property sales rose to 38% on average across the whole of the UK. That basically means that 38% of properties sold within a month in the UK property. It's traditionally been about 12%. So it's more than 3 times the demand than we're typically used to. Average asking prices up nearly 15% in August. Rental stock availability down to 31%, like for like in August as well. So we've really got a shortage of rental stock. Rental inflation up 13%. So while property's grown around about 11, rent's actually grown at 13. And what we actually saw is the property market reverting to pre-COVID patterns of early summer and early winter slowdowns. So people are saying, oh, the property market's slowed or it's stalled or it's not as busy as it was. Well, it is. It's just as busy as it was. And in fact, when I publish September's data in a couple of weeks, you will actually see that September was one of the busiest months we've had in terms of transactions. So people saying that the summer slowed down are wrong. What we actually saw was a rebound in demand during the summer months. It's just that the data that people use isn't necessarily accurate enough. And I'm conscious in getting into quite a fair bit of detail here, but what I want to try and do is visualize this for us. So imagine asking prices, they go up, they peak, then they dip a little bit, and then they grow again. It's not a linear line. This isn't something that happens in a nice linear way. Rent prices also change. So we've got asking prices to buy properties in the market. We've also got rental values. Rents also go up at a particular rate, and then they'll reach a peak, and then they may dip a little bit, and then they go again. Typical S curve. And then we've also got demand for stock. The demand we see grow and grow and grow, and then it may slow down a bit, then it might dip a bit, and then it goes again. So what is critical for us as property investors is knowing this, because most people don't know this, they don't understand it. Knowing that you will see demand, then rent asking prices increase, then property sales asking prices increase in that order. So right now in September, we've had a large amount of turnover of stock. that is going to push the rental market up a bit further, and it's also going to push up asking prices a bit further. And then at some point later on, when we've all done our transactions, our properties are sold, it's sent to the land registry to register as a sale, and then they publish their data. That's about 6 months later when we actually work out where the market is. So most people are focusing on the sold prices, which is too late. And people like us can focus on the key measures, the key insight measures: demand, average asking rent, and average asking price change. And that is really how you crack it. That's really how you understand what's happening in the market. There are external forces at play that are national, such as interest rates and inflation, and there are local pieces of information, events that impact the market, such as new factories being opened up nearby, schools expanding, hospitals expanding, new employment opportunities, increases in wages. You can try and work all that out yourself. You can try and get all of that data from government websites, from different data sources, the ONS. You can try and do all that yourself. All right? And I did that for many years, and I could never fully do it for all of my areas every single month. And I had to do it in a very concise way, and I actually ended up employing people to do it for me or with me to make sure that I got that data. And now with Ultimate Property Dashboard, we do all of that for you, so you can have that level of insight delivered through a software product now, rather than having to manually do it all yourself. I won't dwell on it too much. What I will do is I'll just give you some salient points, just things that we need to know right now. Cash purchases, so if you've got the cash to buy a property at the moment, they are generally 9% lower than the equivalent property being bought with a mortgage. So if you're buying cash, you should be expecting to buy that for 9% less than someone who's buying it with a mortgage. There is no growth in buy-to-let mortgage approvals. So the number of landlords in the market, the number of property investors in the market is not growing. There is no growth, and also there is a fall or a reduction in availability. So that's creating pressure upwards in terms of value. And the repurposing of stock of private rental sales is now negative. So what we used to have a lot of people buying properties and converting them into rental properties, and now we've seen a big surge in that over the last 10 years, and that's stopped, and it started to turn into people buying properties to sell them on, or buying properties to live in, not to rent out. So that means that there's a further contraction in the availability of stock. We've also got wage inflation. Current wage inflation is 5.1%. The private sector is 5.9%. Okay, so the private rented sector is seeing in wage inflation at 5.9%. And the public sector, at the point at which our slide, is only getting 1.8% at the moment. But interestingly, retail, hotels, and retail, wholesale had the highest increases at 7.7%. So the typical type of people that you would rent to, the typical type of people that would maybe be first-time buyers, their wages are going up the most. Retail, hospitality, and public sector workers make up about 62% of the employed private renters in the UK. So what I find bizarre at the moment is you've got a large sector of the tenant population getting above national average wage increases, and yet there is a lot of talk and a lot of negativity around the cost of rents. Rents are going up because people's wages are going up and they can afford to pay more, so they are moving within that rental market. But that doesn't get reported by the media because they don't understand this level of data. What it does mean also is that there's a lot of headroom for further wage inflation, because the public sector is only getting 1.8%. That can't continue with inflation at 10%. And the whole private sector is only at about 5.9%. Again, all of those figures are behind the general inflation that is out there in the market. And what that means is where there is going to be inflation, where there are going to be more people earning more money, they can afford to spend more on a property, and ultimately, relatively, it's the same amount or the same burden financially on them. In an area where they earn 28,000, they can get a £140,000 property, and an area where they earn 38,000 on average, they can have a £190,000 property based upon the 5 times household income multiplier. So top tip for you, high growth locations will be the highly affordable locations. Problem is, nobody knows how to work out where the affordable locations are in the UK. Well, well, that used to be the case. In today's world, we can use Ultimate Property Dashboard to do that for us. Now, in terms of a forecast, we forecast that the property market is going to slow down, but it's not going to fall. Okay, so the growth is going to be really high in property values right up until December, and then it's going to start to that growth will still continue, but it won't be as high as it has been this year. It'll start to level off at around about 8-ish percent increasing by sort of April next year, and then by the time we get to the end of the year, I'm expecting it to be around about 6 to 7% house price growth, which is still great. I mean, that's a great return on your investment, and because it's leverage money a lot of the time, that's really good. Plus, you get the rental income from it, so it's good. But critically, I am not forecasting a crash in that data at this moment in time. It's not my opinion. That's what the data and the models that we use in Ultimate Property Dashboard and Ultimate Landlord is telling us right now. Okay, so that's what we can already see in data. And again, some more observations. The rent market indicates the direction of the property market. The rent market's really strong at the moment and is growing further. And there's some things that I want to talk to you about in a moment when it comes to rent. The affordability of property is likely to stabilize and mirror. So if you've got more people earning more money, they can afford to spend more on property. That drives the property market upwards because we haven't got enough supply. So they can afford to buy it, they will, because there is enough supply. Inflation will remain high despite falling later next year, and it's possible. I said I should really update this slide now. It absolutely is the end. This slide was done a couple of months ago. The end of close to zero interest rates across the Western economies, UK being no exception, and we're absolutely seeing and feeling that over the last couple of weeks. The other thing to watch, particularly if you're an international investor at the moment, if you've got a lot of money held in dollars or other currencies, just bear in mind that the pound has really dipped in value recently. So in real terms, it makes UK property cheaper to own. And for those of us that are not international investors, I would warn you that, you know, in real terms, British property has got cheaper if you're buying it through foreign currency, if you're using foreign currency to fund it. In real terms, British property has dropped significantly in value, around about 20%. So guess what a lot of investment firms are likely to do? They're likely to pour more money into the UK property market, particularly because it's quite a stable and secure bet. So that is also likely to push values up. And then obviously we've got the issues geopolitically. We've got to watch out for politics in South China Sea and Eastern Europe as well, and other headwinds. So you know, bear in mind, America's gone from being neutral to protecting China. NATO's pouring resources into Ukraine. China and Russia relations have got to be watched. OPEC is already announced that it's going to reduce production, so as pressures intensify. And just a little observation that I make outside of property is that technology stocks might take a quite significant hit in value, and that could have a contagion effect across other parts of the stock market. So they're the things that we need to be worried about. One of the main things, though, for us, and I touched on this a moment ago, is inflation. So we've got input costs, which we looked at, process cost, and then output cost. This is how we understand what's likely to happen to inflation in the UK. And this is going to be the most fundamental part of the next 2 years of investing for us. What on earth is going on with inflation, and how do we manage that so that we get a better position? Now, if you look again at this graph, this shows us input into the economy in terms of manufacturing and output into the economy in terms of manufacturing. So cost of stuff going in, cost of stuff coming out of factories and businesses. And you can see that that's climbing to the levels we only seen back in 1975, some 45, 46, 47 years ago. We've not seen this amount of inflation in what's going into the system. So what comes out the other end is going to be seen in our data in the near future. This is why when people say, well, the Bank of England says interest rates are going to get inflation under control, no, they're not. No, they are not. I don't care what gets published in the media. Right now, we have got a load of extra cost in the system that hasn't reached us yet. The input cost, the cost of materials going in is very, very high. The output cost, the stuff that comes out of the factories and the businesses that make things and create things, is very, very high. And that's going to be seen in the retail or the consumer prices index over the next 3 to 6 months. So they can, Bank of England can put interest rates up as much as it like. It won't have a major impact on inflation. And also, if you look at what is currently holding things back, controlling things, crude oil and fuel, we know that OPEC has reduced the amount that they're going to produce. So, what I like to do is look at where things are going to be in the future, not where they are right now. This is the all manufacturing annual rate of inflation, this figure at the bottom. On a month-by-month basis, it's going up 1.6% a month, and on an annual rate, that's currently at 17%. So the stuff that was coming out of factories last year is now 17% more expensive, and that's before we consider the slump in the pound and the cost of importing goods as well, which is also a lot more expensive. So inflation is not something that's going to go away. Bank of England mortgage data, I mentioned this earlier, we are not heavily leveraged. We are not all taking on lots of debt in this country. In fact, it's been reasonably stable for the last couple of years in terms of loan to value. So we're not seeing a huge increase in 80% mortgages, 90% mortgages just yet. The mortgage market's been reasonably stable. And again, if you look at this data here, you can see that the orange line is probably the one that I want to draw your attention to. Buy to let. That's generally a bellwether, a measure of how much activity there is in our industry, in the investment industry. And you can see it hasn't grown at all. Right? There's not a lot of more of us. There's just less stock, less transactions, fewer transactions. The main growth is in remortgage, people taking some extra money out or changing their product, which you would understand, and that's going to continue to go up, and also people who are moving home. We don't have more first-time buyers coming to the market either, and that's something that is critical for the growth of the economy in future. And it's very likely that you're going to start to see incentives and particularly politicians, but also financial institutions trying to tap the first-time buyer market and grow their businesses through that sector, not necessarily through us. Now, when I'm talking about us and mortgages, if you take nothing else away from this session, all right, make sure you take this away. The stress testing of mortgages in the UK has changed dramatically in the last few weeks and days, massively. This is a significant change. When we used to test stress mortgages pre the recent change, or certainly August and before, we generally stress tested at 125% of interest payments. So that means that the rent needed to be equivalent to or greater than 125% of the interest payments at 5% on a mortgage. And now, today, and it's probably going to change by the end of the week, it's at 125% of the interest payments at 8%. That doesn't sound a lot. Oh, it's okay. You're just stress testing a little bit higher. I'm okay. I've already got my mortgage. I'm happy. But no, it doesn't matter. It matters hugely, because £100,000 mortgage at 8% interest per annum is £8,000. That's how much interest you are being tested against, irrespective of what your mortgage product is. So if you put that into 12 months, that means that it's £633 a month of interest. I know you don't pay that, but this is what the banks and the mortgage companies will be testing you against. That's £633 a month. If you multiply that by 1.25, that gives you the 125% of interest stress test. And I don't need to tell you that is a number which will be scary for some property owners right now. For every £100,000 worth of mortgage you've got, you need to generate today £833 of rent. And I know a lot of us won't be achieving that. And I know a lot of properties out there don't achieve that, because I have that data in Ultimate Property Dashboard and Ultimate Landlord. There are lots and lots of property owners, investors, landlords right now that are going to be hit by this when they come to renew their mortgage products. when they get to the end of their fixed terms, when they've got to renew, when they've got to extend, they are now going to have to demonstrate to a lender that they are getting £833 per month in rent for every £100,000 of mortgage lending that they ask for. And a lot of them are not going to meet that criteria. In fact, a majority of them are not going to meet that criteria. So this means one of two things. First of all, very exciting because there's going to be property owners and property investors and perhaps tired landlords who are perhaps going to exit the market and look to sell their properties. That's a good thing. That'll bring more properties onto the market, provide a bit of stability and give us something to buy. There may also be discounts. But also, it's also a signal right now to us all that you need to be correct in your rents. If you've got any rents that you've been thinking about putting up for a little while, or you plan to do it in a few years' time, well, you need to be having the conversations with those tenants now. You need to be saying, look, this is the situation. I won't be able to keep this house if I don't address the rent and do a rent review with you. And you need to be very honest with tenants, because if you can't just drop these huge increases on them, you're going to need to build up to it, particularly if you're on like a 3-year or a 4-year or a 5-year term on your current mortgage product. When you get to the end of that term, you're going to have to be able to reflect some of these new stress tests. So it's good because there's going to be landlords that don't want to do this, that aren't able to put their rents up, and they're going to exit the market. It's terrible for tenants in two ways. One, they're probably going to be losing their homes. Two, they're probably going to be staring down the barrel of big rent increases or rent inflation. But for us, it's also the prime opportunity for us to be honest with our tenants and let them know that we need to be addressing their rent because of circumstances outside of our control. You didn't put the interest rates up. I didn't put the interest rates up. The government took action and has created a scenario where the Bank of England has put up the interest rates and mortgage companies are reflecting that. So it's not our fault, although we get blamed for it. It is out of our control and we have to reflect it, and you do too. So that's all positive, isn't it? Let's talk about what this means for us. Should we buy? Should we sell? Should we divest? Or should we change our strategy? So one of the critical things is in all of this is going to be a real opportunity for us to go and buy properties and get money off. It's going to be an opportunity for us to buy in areas that are going to go up massively in value. It's going to be an opportunity for us to buy in areas that are going to see rent inflation, so our yields are going to get better. And all of this stuff is now happening. So this is the opportune moment for you to find that high-performing location. And again, if you're going to find a high-performing location, you've got a choice. You can try and work out the supply and demand and how that relationship works in a particular area on a particular property, or you can use software to do it for you. So really, if you want to measure demand, you've got to look at the scarcity of stock, the employment situation in that area, the attention that the market is getting in that area, the lifestyle changes in that area, what types of lives are people leading, does the property lend itself to it, the physical demand in that area, so the turnover of stock, how the sentiment is in the general media and in the local media, the affordability, critical that one at the moment, the affordability for the people who live in that area of properties in that area. Now, London is a good example here. For many years, the London property market has stagnated. If people in London are going to get high wage rises over the next 12 to 18 months, then the properties in real terms get more affordable. So there's an opportunity for those properties to go up in value. Also, the return on investment versus other markets. Some investment markets, I think, are going to have a real tough time. We've already seen cryptocurrency have a bit of a difficult time over the last sort of 12 months. We may see other markets have the same thing. And critically, and we're feeling this now, the availability of credit. If the credit market holds up, there will still be demand. If all the mortgage products are pulled and we can't get mortgages anymore, the demand may fall. That's a one to watch, because if the interest rates keep going up and the stress tests keep going up, we may see a bit of a fault in the credit market. But then we got supply as well. Are we building more stock? Absolutely not. My local authority where I live published a thing on social media earlier, which made me laugh. They built 15 houses and they were celebrating the success of 15 houses in an area that has got a population of 300,000 people. It isn't enough. The speed of sale, how quickly stuff is selling, the listings, the availability of stock, the local employment situation changing, and the population changing. At the moment, in most parts of the UK, they are out of balance. There is more demand than there is supply. And those critical measures are all higher in a lot of areas, not everywhere, but in a lot of areas, the demand is significant and it outstrips supply, which means that the market will continue to grow until an external factor stops it from doing so, or the market balances. But not everywhere is in that space. Some areas don't perform brilliantly. I'm not going to talk at length about the changes nationally and regionally, but there's a couple of things in there. Bear in mind the EPC changes that may or may not be enacted by the current government if they last long enough. There's also a significant manufacturing shift to the north of the UK at the moment, and big changes in employment. So if you are thinking of investing in the north of the UK, or if that's somewhere where you're active, bear in mind that employment is changing, wages are rising quickly in those locations, and there's a lot of manufacturing which is putting pressure on certain parts of the north in terms of availability of property. Okay, I often do this. Bear in mind, if you're going to invest in a city or a local area, not everywhere performs the same. Most of an area will perform averagely. So if Manchester is growing at 7%, most properties will grow at 7%, but some won't. Some will only grow at 2%, 3%, and some will grow at 10%, 15%, 20%. But you need to know which properties and which specific areas of Manchester where that's going to happen. And that's how I make my money investing in property. I use the data to inform my knowledge and make sure that I'm investing at the right time. But then I look locally at what is happening in a local area and only buy the properties or invest in the property types, the strategies that are overperforming. So exactly what postcode, exactly what type of property, exactly what price I should be buying it for is stuff that I need to measure. And that's hard for us because that's what people used to call due diligence. But when you ask them, how do you do your due diligence? They don't answer you because they don't know how to do it. Look at this data here. This is a little bit old, so don't take this as this month's data. It's not. It's just I use it as an example because it was a good point in time. This is Northampton. These are the NN postcodes, Northampton postcodes, and you can see there's two measures. There's the dark green, which is demand. So the demand for properties, the turnover of stock, which I can measure and you can have access to. And then the green is the price change. That's what people typically respond to. The land registry sold prices. So, if you look at this data, you would say NN1 with the light green bar is a really good performing location all the way over on the right hand side of that chart. NN1, light green, the price change is good. That market has gone up 13% in the last 12 months. Fantastic. And you'll get most property investors will invest in NN1 because it's gone up 13%. Right. But what most investors won't do is say, well, that area's already grown. I want to go to an area which is going to grow. We miss that as an industry. We miss that as investors. We want to invest in the highest demand area, which is NN2. The turnover of stock, the demand is 30% in a month. So almost a third of all properties sell within a month. And in NN1, it's roughly half that. It's actually a little bit more than half that. It's 13% sell within a month. So NN2 is having its moment right now, and NN1 has had it. It's had its moments. And we know this when we look back. We say, oh, yeah, that makes sense. NN1 had a growth spurt, then NN2, then other postcodes as we move out. So NN2 is having its moment right now. That's where I would invest. I would invest there because it's got the highest demand and it hasn't grown by much yet. So it's got more potential to grow. And this is how, in my portfolio, I only buy in areas where I'm likely to see my properties go up in value by 20%, even if I do nothing with them. Because if I can buy a property that goes up 20%, I can refinance it and get my money back out without having to do anything. And that's how I built my portfolio up. I also do a bit of refurbishing as well to add that, to make that return a little bit sweeter. But I use data to buy in those areas where no one else. This is a fixed point in time, and it's not a big city, Northampton. However, there's huge variance in demand and a huge variance in price changes. So I just act in those areas where other people aren't. And because I do that, and I'm constantly moving, not all over the UK, but just different postcodes in an area at any time and different property types, I make sure that I maximize the return on my investment. And this is critical understanding what drives demand, because again, remember, most people will buy when the property market's strong. Oh, the market's up 10%, I'm going to go in and I'm going to buy, fear of missing out. But what we need to be doing is buying at the start of a growth cycle in an area when there's a lot of headroom for property values to grow. That's what I want to invest in. I don't want to buy the property that's gone up loads in value. I want to buy the property that is going to go up a lot in value. And that way, I miss this dip. If there is a dip in values at any point, whoops, if there's a dip in values, I'm protected because I bought at a lower point in the market. I didn't buy at the top. And this is something that's really important. People just so often miss out. And yet we understand this in other spaces and in other investments. So, I can understand where I'm at by looking at these sets of data: asking price, asking rent, and stock turnover, because you see those measures looking good or bad before you see the effect on sold prices, the land registry data. So if you're looking at demand, stock turnover demand, you're looking at rent inflation, and you're looking at asking price inflation, that's a good area. If you're seeing the asking prices are slowing down, the rents are falling a bit, and demand is really low, that there's going to be a correction in that market. So being able to measure those first three, the green, blue, and red lines, is more important than that black line at the end. Yet so few people do this. Again, that's your insight, that's your forecast. You can do this. Now, again, when we talk about affordability, and I know a moment ago I talked about household incomes, look at this. This is Cardiff, which is not too far from where I am. This is not the cheapest areas in Cardiff, the cheapest postcodes. This is the most affordable postcodes for 2-bedroom properties. So in CF36, it costs 7 times the average income in that area to own a 2-bedroom property. And in CF47, it's only 3.5 times the average household income. Now, see, that doesn't mean that CF47 is the cheapest area. It means that it's the most affordable. Property values may not be cheap there. It may be that people earn a lot of money. Looking at data this way helps me to understand where I can buy a property and where people can afford it, and people are likely to pay more for it in future, because this will all gradually try and balance itself out over time. So those areas that are very low, they will suddenly climb. Those areas that are very high, they will suddenly fall. So knowing where is most affordable right now is important. And also you've got all this wage inflation pressure. So a lot of areas are going to get more affordable, and you want to be investing in those areas. Again, if you can do this manually, then please do it, because it's important. If you can't do this manually, if you're not sure how to do it, you should use software like mine to help you, because I know it's a cost, and I know nobody wants more software in their life, but when you're talking about hundreds of thousands of pounds, this is going to make you thousands of pounds understanding this level of detail. And it's not difficult. It can be made really easy in software. And again, you can see that in the Southwest, I can very easily tell you the highest affordability postcodes, and I can also tell you the highest yielding postcodes anywhere in the UK. And you can have access to this data too, and you should. And I make no apologies for saying that. Now, most presentations need to have a fast car in them. So there you go. There's my fast car. Apparently cars hook people and get people excited. And I don't really want to talk about the bling, but what I do want to just draw your attention to is you have a choice as well. In this market, which is moving very quickly, you can try and get lots of data, and you can try and shop for properties using all of these different tools, Zoopla, On the Market, Rightmove, Spare Room, Facebook, your emails, even legislation. You can do that. You've got a choice. You can carry on doing what everybody else is doing, or you can do things a little bit differently. And remember what I told you, we want to be buying at the start of a growth cycle, not at the end of a growth cycle. So I would like to show you how I do this in my software. I'm not interested in spreadsheets. I'm not interested in loads of data. I want an at-a-glance view of what's happening in the market. So M34 there, we've got good prices, good price growth, 3.4%. We've got good rent growth, 2.7%, and we've good demand, nearly 50% turnover of stock. So that's good. But then on the right-hand side of there, for M34, of that tile, you'll also see some colours, green to red or red to green. And you see little blue arrows on top of those colours. That tells me, is that a good performance compared to all other M postcodes, all other Manchester postcodes? So yes, the amount of properties going up in value is good. Yes, the rental market is good, albeit in the middle, sort of yellow, so it's average. But demand actually isn't as good as other M postcodes. So perhaps I should look somewhere else. Then if I look at the next one, EX17, I got really good value growth, 8.9%, fantastic. And that's good for the area. I've got good rent growth. So again, that's good, but I've also got, that's also one of the best in that area. This is Exeter. And also I've got 47% demand. Now that's not as good as Manchester, but we have the indicator more towards the green because that level of demand is good for that area. It's actually better than the average. So rather than trying to work all this out through formulas and spreadsheets, I just look at these charts. If I've got signs of it not doing so well, it'll indicate red. And I also need to know, is it good compared to other properties in that area? So this is how I quickly get through absolutely stacks of information and get insight into what I should do next. Not going to buy an M34 at the moment, probably going to focus on EX17. Definitely interested in some of those other posts, PR7 as well, and a few others. So that's how I do my area analysis super quickly. I also, and again, you see this in a slightly different way here, I also cannot be bothered looking for properties, right? If you spend your life looking on Zoopla, Rightmove, and on the market, then I want to make that life a little bit easier for you if you're searching the market. Use software, right? I've got directly underneath each of the area performances. You can see again, I've got asking price, asking rent, and demand by property type just above. I can also see what properties have come onto the market. Because I gather this data every day for every property in the UK, not one or two or a sample set. I have every property every day in my data set. That enables me to be able to say, well, actually, this property I think has got, or these properties have tenants in them. These are tenanted properties. So that's of interest to me because I like to buy tenanted properties. They tend to be sold at a discount because the vast majority of the population don't want to buy a house to live in that someone is already living in. So it's only able to be sold to investors normally. So I target those. Also things that need quick refurbishment, things that are in need of a quick sale, properties that are commercial, also of interest to me. I use my software to find those for me every day. That's something that you can do. Let me very quickly show you, because I'm very close on time here. I need to show you how I use all of that data and how I get that insight super quick. So this is a live version of my software. Just lower my volume down. So I'm simply going to look for property. Okay. I'm not going to do anything more complicated now. I'm going to look in the Liverpool area in the L19 postcode. I'm going to drop pin. So it's 15 miles around that. And I'm going to search for some property. And there are 9,963 properties for me to look at, sorted by how recently they've been loaded onto the market. So these first few are the ones that have come onto the market today. If I click on the image, it takes me to wherever it's advertised. I don't care which portal it's on. I haven't got time to search all three. So the first one was Rightmove. The second one is a Zoopla property. And somewhere further down, you will find a property that's listed on the market. Again, there's HMO data in here and the single let data or house data. There's also commercial as well in this software. Now, typically what I like to do when I'm buying a residential property, a house, is I like to buy a certain type of property. So I'm interested in stuff that needs refurbishment, quick sale, repossession, price reduced, tenanted, chain free, cash only, new build. Again, because I've got every property, I can also use software to do keyword searches for me. So I'm going to now search about 900 keywords. And that's going to take a little bit of time for nearly 10,000 properties. But it will reduce the amount of searching and the amount of notifications and the amount of research I've got to do down to 1,132 properties. So that did in seconds what it used to take me days to do. Now I can also add some filters to this. I can also say, well, I only want to buy properties that are a particular price. I'm only interested in properties under £200,000. And I can apply that filter. And then my search is refined even further. I'm now down to just 15 properties to look at. And those first two have come on the market in the last 3 days. So now I'm really drilling through the data and getting to what I want to know. It doesn't matter where it's advertised. That one happens to be on Zoopla. And again, this is the speed at which you need to move. Now, I've done the entire market and I've searched 900 keywords, and I'm now able to take a property that I'm interested in and I'm able to save it into my my pipeline. I'm now going to do something with this. I get all of the data that's relevant to me and I save it on my software. So bear in mind, I've done the whole of Liverpool. I've looked at specific strategies that I'm interested in. I have, irrespective of which portal it's on, I have been able to do that analysis, set my budget, and then add it to a pipeline. That's what I do with data. So not only do I understand the market and the areas which are emerging, which are hotspots, which are good, I can also very, very quickly find a property that matches my strategy and add it to my my pipeline. If you want to do that, you can do it using this QR code. And again, it's a special offer this evening. I'm giving away my book with it as well, and you'll get access to free live training on the software as well. So you will be invited to join me live to be trained on how to use the software. It won't take long. You'll have it. You'll be using it yourself within 20 minutes, I promise. But I will extend that training for an hour. And you can cancel it anytime. It doesn't cost you anything to cancel it. And you can subscribe for from £7 a month. So I think that's pretty competitive given the amount of time that you'll save searching the market. Again, we talked about Northampton postcodes earlier. You've really got to think about what you're doing. I haven't got time to go through all of this content, unfortunately, but I do want you to understand that, like, most people will have this as an example plan: below market value, high demand areas, recycling deposits, decent yield and ROI. The problem with all of this stuff that we do is it's not evidence or fact-based. Not everywhere can you buy below market value. Not everywhere is a high demand area. Not everywhere can you recycle deposits by refinancing. Not everywhere gives you a decent yield or a return on investment. And in order for you to really get the most out of your investment, you've got to know exactly what UK location is going to perform best, exactly what property is going to perform best, what strategy will perform best. Will it generate rent, a lot of rent? Will it enable you to recycle your deposits? And will that market go up or down? So in order for us to make sure we get this right, we've got to have 5 key things: a good deal below where the market is going to be in the future, a good below market value in the future, high rental yield, high rental demand, and high affordability. Those 4 things, if you get them all in a row, that's a Goldilocks property. That is the key. They are the key metrics that you need to be searching for when you are investing in properties in 2022 and into 2023, because that will shelter you from any of the problems that there are going to be, undoubtedly, for some people. It will also shelter you if there is any correction in the market, if there is a dip in the market. I don't know what happens beyond 2023. There could be headwinds in the future. You need to guarantee and lock in some protection from that now, finding a good deal. And again, remember, if you buy the top of the market, you might lose some money. If you buy at the bottom of the market, even if the market takes a correction later, you're more likely to be cushioned from any impact that there is going to be. And again, these are the measures that you need: stock turnover, rent asking price, and property sales asking prices, not sold prices. This is what I gather for you. This is what you need to use in your journey. Now, I'm very, very tight for time, but I've used this to make a lot of money on properties, and I'm just flipping through a few of them. I just want to draw your attention to, with one of my business units, in 18 months, we not only recycled all of our funds through remortgaging, but we remortgaged, plus we had £166,000 extra as a result of using data in a business unit that started with £50,000. So we got all of our 50,000 back, and we also generated an additional £166,000 of additional funds to invest by using data. And if you want to see the examples and the case studies of that, I would be delighted to share them with you, because they are genuine and they are real, and we have done that. Once again, if you do want to have access to Ultimate Property Dashboard, you can do that using that QR code. And I started off this presentation by being quite negative. In fact, it's still a little bit negative at the moment. It's hard to escape the negativity out there at the moment. But when I was young, I talked about my childhood and living in an area that we didn't necessarily want to live in, and things got better. And we were able to do well, and for ourselves, and me and my wife, and we've invested in properties, and we managed to buy a property that we always dreamt of, things that I couldn't have dreamt of when I was a child living in a flat in the middle of affluence. So I bought myself a house, and that's great. And if you like success stories, I'm happy to talk to you about success as well. But what success means for me is perhaps something a little bit more exciting. I was also able to buy my mum a house. So my property investment journey didn't just help me and make me comfortable and brought me success, but when we talk about things like what's possible, and we're here on a Project Possible presentation, what was possible for me was to buy my mum the house that she wanted to live in. And she was medically retired early. She didn't have the financial ability to buy her own home. She got herself into a little bit of a rut, a bit of a pickle she couldn't get out of, but I was able to step in and buy that property for her. So not only do we affect the lives of our own lives and our immediate family, but we can also massively impact the lives of others through using data, knowledge and intelligence and insights to make money from investing in property. So, I just wanted to end on a positive rather than a negative. Just look out for these things when it comes to change indicators in the market at the moment. It's so important that you are on top of what's going on out there at the moment. Do sign up to our software if you're interested in this sort of stuff, because we can guide you through this. And I will end by saying thank you for listening to me speak this evening. Hopefully we've got a little bit of time for questions, Jito, and I'll also just pop up my contact details on the final slide. Thank you.
Thanks, John, for that wonderful session that we had in last 1 hour, 60 minutes of time, more than 60 minutes of time. It was
sorry, I overran slightly.
It's very informative, and the key highlight was your solution, the solution document that you showed in terms of an app which brings your output into a short span of time. You get the results where you need to actually look into. So that was a key highlight of this particular session. And not only that, your analysis, your graphs and everything made. I hope it's a recorded event, so definitely I will get a chance to understand the charts very more deeply and correctly too, and we'll get more out of it from this particular session. So guys, right now I'm handing over this session to Kushal, and he will take you through the question and answer section.
Yeah, thank you very much, Robin. And before I open it up to questions, John, I also wanted to thank you. It was really, really nice with looking at so much data. It's amazing. Like everybody has a question in their mind right now with interest rate going up and everything happening, inflation and everything. Like, should we invest? Should we wait? But it was good to see with a data point of view as well, like what the experienced investors are doing. So you answered the question as per your experience and skills using the data. So it was really good to see that. And obviously the second point which you mentioned was stress testing. So it is also important when we are also doing our deals now, we will make sure that we take into consideration the stress testing factor as well. So thank you very much. For me, it was really, really helpful and a lot of information gained from it.
Thank you. Thank you very much for that. Pleasure. My pleasure.
Perfect. So guys, now this is your opportunity to ask John any burning questions which you have, if you have any deals going on, so you can ask him what is his opinion or anything you like. So floor is all open to you. Maybe you can unmute yourself, ask questions straight away, or if you want to put it in chat, you can. So feel free.
I think while everyone warming up with their questions, I think I got one question for you, John. Now, in terms of the particular dashboard, what you mentioned, and you showed a quick demonstration. Now, for someone who's completely new to the property and they have no clue that should I look for Liverpool or should I look for Manchester, someone who's completely a beginner, what you will advise about this particular application?
Definitely. I mean, that's a critical one, actually, and I should talk more about that. I need a couple of extra hours, please, Jito, just to to carry on. Do you know what? That's a critical one, right? And most people don't know. Even people who've been investing in the UK, they've got hundreds of properties. They don't know where is best to invest. The software helps you with that. So if you're not sure where to invest straight away, you can pick some areas. So you can say, show me all of Manchester, show me all of Birmingham, show me all of London, and it will tell you which areas are best. You can also, there's an option for you to do the whole of the UK. So it will then give you a data set for the whole of the UK. You will need to download that. So it doesn't display it on the web page. You have to download it onto your phone or your laptop or your tablet. But that will then give you information about which areas are best to invest in. So again, it's all done simply. I'm not interested in complexity. I want to know, is it good or is it bad? I didn't mention earlier, when I take my measures for an area, those measures are what the current market is showing me. It's not what has happened, it's what is currently happening. So when I say asking prices, that's how much the asking price for a property is today. And when I look at a comparison, I look at today versus the average over the last 6 months. So our data is really accurate because it's like today versus what's happened in the last 6 months, not 12 months ago versus the 12 months before that, which is typically what we're getting in other data sets. So because we've got that data, you can know exactly which areas are hot, what hot spots there are in the UK right now. So you can pick an area. I know off the top of my head a few. So Hull is pretty buoyant at the moment. So is certain parts of the Manchester and Liverpool area, particularly if you go to the south of those areas. And then there are hundreds of other postcodes all over the UK where there's really high demand. Suddenly an office opens up, a factory opens up, school opens up, a hospital, and so on. So yes, to answer your question, software definitely does that. And the data is really up to date as well. So you're not acting on the stuff that happened 12 months ago. You're acting on what's happening right now.
Thank you, John. Thank you. I think that leads to my next question as well, John. In fact, recently, we brought 2 properties in Preston, and when we did when we did the mortgage application, they will ask for the rental. So we entered a rental of 900.
Yeah.
And the lenders survey calculated the rent as 650. But they still gave the valuation of the property. So it clearly and we managed to secure the offer, and now the rest of the bid is going on. But I was just discussing with my brokers, and the stress test is something really critical. So does our application, this Ultimate Property Dashboard, does it gives us the rental numbers for the property as well?
Yeah, definitely. In fact, do you mind if I show you? Would that be okay?
Yeah, go ahead, please. Yeah.
Quickly show you. So if I do, oh gosh, if I go back on, I might actually have it loaded on the screen. I do. It's almost like I planned it, isn't it? So if I go to lead research, I may need to log back in. So this is, folks, this is live. This is not something that I've pre-recorded. This is a live view. So I'm going to quickly look at an area. So I'll look at areas research. And I'm going to add an area. It was Preston, did you say, Gito?
Sorry, I was on mute. Yeah, it is Preston. Yeah.
So the
PR1 and PR2.
Okay, cool. So let's do PR1. So I've got lots of areas in here, but you can see there I've got some areas. So most areas are going to be red for demand at the moment because demand has fallen. And then we've got the statistics for that area. If I click on show more, I've got a lot of data available. What size property was it, Gito?
One is 2-bedroom and one is 3-bedroom.
Okay, so right now, so this is case in point, right? So the mortgage companies value that at 650. Yeah, the current market for a 2-bedroom property, this is the average, not the highest or the lowest. This is the average, 762 for a 3-bedroom property. For a 2-bedroom property, 1,048 for a 3-bedroom property. That's the current market, right? So unfortunately, and you're going to encounter this, you're going to need to fight against some of the nonsense that you will encounter when you're investing property, particularly valuers. They will have an opinion, and you need to fight back with some facts. So personally, what I would do is I would go to another part of software, which is lead research, the next level up. And I would want to be able to demonstrate to whoever it is that is asking questions, I would want to be able to show them that PR1 values are a particular amount. And I would want to show them, I'd want to be able to show them some details, some analysis. So I'm not I'm going to put PR1 in now. I'm just going to use one of my postcodes, SA6, that I've got on here at the moment. So here are all of the properties. These little yellow dots are all of the properties that are currently on the market for sale. But if I go down, I've also got these little yellow dots for rent. These are all of the rental properties on the market at the moment. And if I want to, I can just click on the yellow dots and it'll take me to wherever it's advertised. And I can click on print, or I can have that as part of my pack to show to a valuer or to a mortgage company, or even just to check myself. So rather than people having an opinion, which a lot of people do, and particularly a lot of valuers do, I always go with this. I print this off, I download it as a PDF and I print it, or I have it loaded up on my iPad, and I show them this is what the market is doing at the moment. This is the average household income. This is the average rents, £856. This is the range, the lowest, the cheapest properties in the interquartile range, which is a statistical measure, is between £800 and £1,000. So I will just tap a couple of these, show for comparables. Also for actual valuations, these are the properties that are currently on the market for sale. And I've got lots of comparables there, but I've also got the ones that have sold as well. And I can click on these and I can view them. And it'll take me to wherever that one was on the market. I bet most people don't even look at on the market as a portal. But yeah, I've got that as to demonstrate the market. And I've even got the demand and the growth in that area. So you can imagine if you're going into a negotiation, or if you're going to apply for finance and you meet somebody who's valuing the property, I always like to try and meet them, or I like to try and have a conversation with them. I also send them this information so they know the reason why I've put on my mortgage application that this property is worth £856.40 in rent. And then how do they argue against it? So you can use this tool for yourself, but you can also use it to influence people as well. And that's a live example there that I've just used. This isn't pre-recorded. This is straight out of my browser.
Brilliant. Thanks, John. It was like, in fact, we kind of challenged the surveyor and the kind of lender. The underwriter was quite comfortable because the surveyor came up with an excuse saying that it was unfurnished. So underwriter said
furniture's worth £300 a month.
That's enough of an excuse, and underwriter gave us the offer. So we secured both the properties. Yeah. But that's really helpful on the dashboard. Thanks, thanks, John.
Thanks very much. I probably answered too many questions.
Maybe I can ask one, John.
Yeah, sure.
So, like, if I'm interested in like specific strategy, like HMOs, do you have anything specifically for that? Like, how can the platform benefit for that strategies?
Yeah, sure. First things first. I think the question is, do HMOs work in an area? So if I again go to area research, let's just clear all this mess so that we can see exactly what's going on. So I'll delete all those areas. So if you were looking to invest in HMOs in the Swansea area, which is the nearest big city to me, so I would say most people go, I don't know where to invest. I need to go on a study tour. I need to speak to an agent, that sort of stuff. I just simply add the whole area. So I'll put the SA postcode in, and I'll select, I don't know, the first dozen, the first 12 postcodes. There we go. So I've got the 12 postcodes. Whoops. The 12 postcode areas in Swansea. I put them all into a chart, and you'll notice for each of the areas, I have got HMO. Okay, so I know now that there aren't any HMOs in SA11 or SA10, but SA1 has certainly got HMOs, and so has SA2. And I can see that in these in SA1 is performing better for asking prices, but not quite as good as SA2. Look at the rent inflation in SA2 on HMOs. So if you've got an HMO and you want to get high rents, then chances are you're better off doing it in SA2. So the next thing is, and actually, before I move away from this, I can just quickly change. I can look at the average HMO price. This is really hard for people to do normally, because you've got 4-bedroom HMOs, 7-bedroom HMOs, 10-bedroom HMOs. How much does an HMO cost? Well, work out the average cost to buy a property per bedroom. So you divide all of those HMOs by the number of bedrooms they got, and you get an average cost per bedroom. So you multiply it by the number of bedrooms to get the HMO cost. And you can see there that it's cheap to buy HMOs in SA1, £42,000 per bedroom. In SA2, it's more expensive. It's £54,000 per bedroom. You can also see that in SA1, you get more on the rent, 522 versus 425, and you get a much higher yield, 14.9% in SA1 versus 9.5 in SA2. So immediately now you know more than most property investors that invest in HMOs in this area from a statistical perspective. You know more. You know how much you can rent it for, how much you can buy it for. Clearly, SA1 is going to be an area that you're going to be interested in. Then you've got to find the properties. So you can see just underneath this tile, so I'll move it down a bit. You can see just underneath this tile, I've got on-market properties. I've also got property sources loading their deals onto this software as well, but there's none in the area for us in SA1. But there are lots of on-market deals. So just click on on-market deals, and there are 321 properties. Then I would simply say, show me HMOs. And it'll go and it'll find, hopefully, some HMOs for us. There are 14 HMOs on the market there that we can potentially buy. So I've done the whole market. I've got all of the portals. I've got all of the properties that are currently on the market that match the criteria HMO. You may also, because you might want to create an HMO, this is an Article 4 area, which means you can't create them without going through planning, but there'll be some areas where you don't. So I also want to look for properties that are listed as being potential development or planning gain as well, because they may be HMOs as well, and then just apply that. And it might throw in some more. It throws in an extra 3 properties, and lo and behold, look at that. It's thrown in a £95,000 potential HMO for me. So yeah, I in the space of seconds, you have analysed the market, you've decided where you want to be, you've got the latest and most up-to-date data, and you've just searched the entire property market for HMO and potential HMOs and got them delivered. And if you click on that advert, it isn't on Rightmove and it isn't on Zoopla, it's only on the market. So if you only ever search Rightmove, you would never find that property. So that's how I would use that's not how I would, it's how I do. Hundreds of other people are now using this software to find opportunity more quickly. You don't need to be knowledgeable about an area. You don't need to even be in the UK. You can do this when you're on holiday. You can do this in the Caribbean when you're relaxing. You can do this when you're traveling through Europe. You can do this when you're at the airport terminal. It doesn't matter. You can do this anywhere, and you don't need to go and do all of your, inverted commas, due diligence that everybody goes on about.
Okay. So when you said that HMO potential, does the software also take into consideration Article 4 area? Does it tell that this area is Article 4, and when it is searching for HMO potential, maybe it is searching outside Article 4?
It kind of does. It doesn't. It's not 100% because Article 4 is constantly changing. Some areas become Article 4, and there's lots of change. So it's simply trying to work out through. What we do is we read the text. Our software reads the text, so it's looking for details in this text to indicate that it may be an HMO. So it says to be sold at vacant possession, but most recently that's £700. And then you can see here, there's something in the text that makes it think that it might be an HMO. And you can see it's now sold at vacant possession as previously had an HMO license. So even though this is an Article 4 area, because it was an HMO in the past, you may be able to reinstate it as an HMO. So you didn't need to read that. You didn't need to know that. You just needed the software to go and find that potential lead for you, and it's done it because it was a potential development property. So, no, it doesn't. It won't always know exactly where the Article 4 area is, because sometimes the Article 4 areas go split postcodes in half and all sorts of stuff like that. But it's clever enough to find properties that you could potentially use as part of an HMO strategy.
Yeah, perfect. Sounds good.
Thank you.
Thank you. Thank you.
Well, I'm going to be playing with this software all night.
Yeah, it will be good.
I'm desperate to go and phone up the agent about that property now.
Yeah, it will be very nice. I'm going to log into your demo and try it myself now because it is very interesting.
Great. Thank you.
Hi, John. Firstly, I just want to say thank you for the great presentation. It was very insightful. I still got two questions, both kind of related. Excuse me. The first one's, you mentioned a lot of external factors which affect property. So firstly, how do you sort of vet the information? How do you know what's accurate, what's sort of fake news? How do you know how to react to that news in terms of your property business?
Great question. Thank you for that, Mark. You can get lost in the media and the talk and the noise, and it's really bad at the moment, isn't it? You know, you'd swear that the entire market is going to collapse and everything's going to go really bad. And then you get some people who say it's like 2008. Well, it's not like 2008 at the moment because we've still got credit availability. So I will look at how many mortgage products are on the market at the moment, and is that stable? So a lot got pulled, but then a lot came back onto the market. So we've got availability of credit. We haven't changed the deposit criteria. We have changed the affordability for property investors, but it doesn't affect 99% of property purchases because only 1% of properties are purchased by people like us, property investors. So the market's reasonably stable. Nothing massive has changed. But what we do have at the moment, and when I'm looking at the data, I'm looking at which sets of data have the most influence on property values. And at this moment in time, the most influential impact is the availability of stock. That's what's driven values up. So if you've got falling demand, then that's gonna the availability or the demand and the availability are gonna it's gonna change, it's gonna shift. So if you've got high turnover of stock, that means that properties are going to continue to grow. If you've got low turnover of stock, so people are buying fewer properties in an area, that's an indication that it's likely to slow down. So I look for that, and I look for that nationally as well. So nationally at the moment, yes, we've had a reduction in the turnover of stock over the last month, but that's to be expected because nobody knows what the heck is going to happen next. And we're waiting. And then I guarantee you that in this month's data, we'll see a big surge in demand because everybody rushed to get their mortgage products over the line and get properties bought before the interest rate rises and get their products through. And I can again see that in the data. The next most important thing in terms of the health of the UK property market is one that people don't understand in the more general media. We say that properties are too expensive. We've all heard that, haven't we? Properties are too expensive. Well, I've been hearing that since 2001, and that was 21 years ago. So we've had 21 years of properties being too expensive, but we've still had loads of properties bought and loads of properties sold, and we haven't seen huge slumps in values. The perception that properties are too expensive is wrong. If you if you divide the average property price with the average household income in the UK, it's been pretty steady for 20 years at about 7 to 8 times the average household income. That hasn't, right now, people's incomes are increasing, and they will probably increase quite dramatically, which means that measure, that metric, how as a multiple of household income will reduce, which means in real terms, I'll get beaten up on social media for saying this, but in real terms, property values are actually falling relative to people's incomes. So that's what that's what's about to happen now. And some parts of the UK have got much higher wage inflation than others. So that's the next most important part of the data. So you can try and follow silly rules like property values increase every 9 years and only buy in areas with near to train stations and all of the stuff that I hear out there that doesn't make any write letters in coloured ink and send them to landlords and they all convert and all of that sort of stuff. You've got to just remove that from your strategy and just look like this area. Is there demand? Is it affordable? Can I execute my strategy in this area? And I just simply focus on that. I know I'm kind of not quite answering your question because it's different in every area. Suppose the most honest answer is I only trust the data. I only trust data that I can interrogate. So when I see headlines, I don't look. I'm not interested. I want to. It's like inflation. Oh, inflation's going to come down. It'll come back down soon. It's got to come back down. Really? Well, no, because the pound has dropped dramatically, which is going to increase the cost of imports. Also, we've got the manufacturing sector in the UK that has got 17% inflation already in it that hasn't come into our retail space yet. So I've look at the headlines, but I can actually go and check the facts. We can't do that for everything, but we can do that for a lot of stuff. And that's kind of what I do. And I'm more than happy to help people. If you subscribe to the software, you can get my updates, and I'll be sharing information with Jito and the Project Possible team to help us through the current months. So, keep in touch, keep coming to these meetings, because we'll be able to share that information amongst the community.
Thank you, John.
Pleasure. Thank you. Good question.
Any other questions, guys?
I don't have any question, but I just want to say, John, it's an exceptional presentation. I think in terms of data, I work with a lot of data, and you're right, there's not much data in this industry, and you're solving a huge problem with your product.
You're right. Thank you for saying that, by the way, because that means a lot to me, because this has been a passion of mine for about 10 years, and I've not been able to express to people the importance of this. You're going to spend huge sums of money. You see people spending their life savings, and they've been on a course and they've been told to do something, buy an HMO for cash flow typically, and then they go and they waste all them. Not waste, they spend all of their money, all of their time, all their effort in an area that doesn't work, because they've convinced themselves that it'll work, because someone else has convinced them that it'll work. And I just seek to try and shift our industry away from that, which is wrong, to a space where there's a huge. Ultimately, what we're doing is we're saying that there's not enough property in this area to meet demand, or the property is of the wrong type. So we're going to create the right type of property to meet the demand in that area. And to my eyes, that prevents stresses within the market, and it prevents homelessness. So I'm tired of being beaten up as a landlord when I know that if I create a property, I can resolve a major bottleneck or issue in terms of availability of stock in an area. And I'm going to go on a bit of a mission to try and express and tell people more about that. Problem is, in the past, it was our opinions, and we just get battered down. We'd get hammered because we're property investors and landlords, and we don't care. Actually, a lot of us do really care about what our product is like and what our customers are like, our tenants. And in the future, now that we've got this level of data and we've got people using it, we can start to argue our point much, much, much more confidently, and without the need to have an emotional argument. We can have a statistical argument about the reason why you absolutely should have properties in an area, absolutely should have more property investors investing in an area. And the more we use this data and the more we act on that, I think the better our industry will be. And I think it'll be easier for us as well. To be honest with you, I'm a bit lazy. I don't really want to search all these portals. Portals were invented 20 years ago. They're just search engines. People pay a lot of money to advertise, or businesses pay a lot of money to advertise on them. I think their days are numbered. I'm bored of it. I just want to know where the properties are, whether or not they meet my criteria, and then act on them as quickly as I can. So I use software to sort of shortcut that. And then I also want to know if is an area going to perform well for me. So, unfortunately, that same set of data that I've consolidated can give me that insight. So I just use that data, and then, I make money. And also, actually, let's just park the money for a moment. I solve problems for people. I provide great homes for people to live in. I'm very fair and reasonable on my rent, and I'm very, very keen to make sure that my properties are well maintained. And I think there's lots of us that I think most people that are on this call will fit into that criteria and that category. We really care, but we don't have a voice. Now we've got a voice.
Well, thank you, John.
Sorry, you hit a raw nerve there. But thank you very much for the lovely feedback. I really appreciate it.
Hi, John. My name is Aarti.
Hi,
Yeah. So I don't have any question, but I'm UX designer, and being UX designer, I 100% trust data. Okay, I take decision based on the data, like whenever I take any decision related to my app. And I never thought, that I can, use like a dashboard to find a property. Like I never had that thought in my mind. And like, this is, I mean, imagine, right? Like in my profession, every day I see the data and I take decision. This is very interesting. So I'm gonna use the demo for 1 week. But yeah, I mean, this is good. Yeah, thank you.
Thank you. And I really, if nothing else, I just wanted to save everybody time. If you search Zoopla and Rightmove and on the market all of the time looking for property deals, you add up all that time over a month. It's a lot of time. And I'd just rather automatically do that. In fact, I'll show you actually, I didn't show you this earlier. So on my dash, all I do when I look at the software in the morning, when I get up, I make myself a cup of tea. I get my children ready to go off to school. And I have a quick check of what's happening in the house, check the mail. But then I come on here and I just look for my areas. So you can see I can scroll across. I can do this on a phone. All of my different areas that I'm interested in buying in. Directly underneath, I've got my leads, the probably the stuff that's come onto the market. So I don't, rather than search, I just tap on, if I'm interested in SA6, I tap on the listings and it gives me the 9 properties. Now, bear in mind, 1, 2, 3, the first 4 properties there have come on the market this afternoon. And I don't need to go and search. I don't need to worry about my alerts. Don't need to worry about the portals. These are the first 4. You can see, just may be able to highlight it, maybe not. The first 4 are 0 days on the market. So they come on the market today. They haven't even been available for a day yet. And all I do when I'm having my cup of tea is I sit down, I tap on it and I go, is that something of interest to me? That one is on the market. Yeah, maybe I'm interested in that. Is this one of interest to me? No, it's too expensive, and so on. And I can search for it. In fact, the first few there are all on the market. So on the market tends to list properties earlier than other portals. And if I do like the look of a particular property, say I want to do, I like this one here, I just tap on the icon at the top and I save it. And then I can come back to it, I can come back to that property at a later date. I don't need to do anything. I have my cup of tea. My children need to go to school. I just press save. It's done. So that's it. I've found a property this morning. I know I need to do something with it. And then when I get time later on, when I'm having my lunch break in work or later on in the evening, I can come back to this property because they're all saved in this part of the software called Deal Analyzer. You can see all of these properties. You can see that one, the first one there, SA6. That's the one that I've just added today. That's a prospect. It's in my prospect section. And I can do something with that. What do I want to do? I'm probably going to buy it, refurbish it, and then refinance it. So I can click on one of these little icons and I can add a strategy and build it up to see whether or not it works. I can also look at the market insights for that area. What's that area doing at the moment? So you can see my little green sliders are there and the price analysis is there, and I can look at comparables within that area. So I've had my cup of tea. I've come back to it later on in the day. And then if I want to, I can build a strategy up. So I just simply do a buy, refurb, refinance. So I'm going to try and buy it for 100,000. It's going to be vacant for 2 months. Hopefully when it's done up, it'll be worth, I don't know, maybe 140,000. And the rental income will be £800. Oops, not 8,800. So there we are. And then I can just go just underneath very quickly. I'm just going to change the refurbishment costs. I think that's going to cost me £17,000 to refurbish. So I've done it. So most people go and pay to do training courses and to learn how to do the stuff. The software does it for me. I can see straight away that the cash flow will be £470. If I choose to refinance it, I'll have to leave £16,000 in the deal. And the return on capital employed or the return on investment is 33%. And if I need a report to review that, I just tap on that button and I've got the full breakdown of all the costs, including how long I've got to leave, what money I've got, or what money is in a deal, how long I've got to leave it in for. So it literally takes me seconds to analyze properties now and work out whether or not I'm going to buy them or not. So that one, clearly, I don't want to leave my money in for 2 years. I want to get my money out sooner. So I'm just going to have to record a more competitive offer, and I'm going to have to try and get it for 90,000. And then if I was to do that, you can see that the return on investment is then 90%, which is much better. That's more like what I want. I want all my money back out within a few months. So I can save that offer and I phone up the agent and make that call. Now the agent might call me back in a week or two's time and say, oh, that offer of £90,000, it's been accepted. So I simply go on my phone I go back to my deal analyzer where I've got all my deals. I say, where is it? It's Millbrook Street. Okay, bear with me a second. I'll just check whether or not I can still proceed with that. I've got a quick breakdown of the property and I've got my report as well. And they may turn around and say, John, we can't do 90,000, but would you be prepared to adjust your offer? So I simply type in a new offer, 95,000, and see what that does to the numbers. That takes my ROI down to 49%, which means I'll be leaving 11,000 in. No, I can't do that, sorry, but I might be able to do 92,500 on the offer. Yeah, because I'm only leaving £8,000 in then, and it's a 63% ROI, and I save it. And this, again, when we're doing this regularly, you then have, because our software will remember all of these for you, you can see all of the properties which you have been interested in, all the ones that you've taken an interest in, you've looked at. So there's 60 there. All the ones that I've made offers on, there are 44. And interestingly, those that have been accepted and those that have been rejected and those that are still outstanding. So I don't need, again, you don't need to have a team of personal assistants doing this for you. You can manage and track all this yourself using our software. So this is all included, by the way, in the gold subscription for the software, which is a couple of pounds. I think it starts from £30 a month. You can have access to everything and do all of this yourself. And as you can see, I bought 12 properties. I've got 27 outstanding, which I hope to buy some of, and I've got some that may come back and phone me in 3, 4, 5, 6 months' time and tell me that the property sale has fallen through. Would you like to buy it? And I won't remember what I did back in May, so I'll just click on the little view icon, and I could see what deal I had planned for that property. And that was a really long answer to a question as well. Sorry about that. I wanted to show you it.
It's amazing. It's very impressive. Thank you. Because what I normally do is I will go on a YouTube, then I will search high yield, areas in the UK, and you will see crap because everyone has a different view. So yeah, this is very helpful. Thank you.
If you need to know the high yielding areas of the UK, again, go to area research. And I mentioned on the presentation, we've got all the UK, so you can just download the whole of the UK. So this is terabytes of data, and we just clean it all up. And there you go. Look, it's almost like I've done it already. There's I've done that for Swansea, but let me just see. Wait for it to load up. A little bit of a delay, sorry. There you go. So now I've got all of the data for the whole of the UK. And you should see somewhere on here the typical yield. So I can now sort the data by the highest to lowest yield in the UK. We'll just get rid of the zeros for a second. There you go.
And this is last 6 months of this depend on the last 6 months of data, right?
Yeah, this is the last 6 months of data. Yeah.
So do we have filter to see the last 12 months of data?
You can see the last 12 months of data as well, but yeah, that's in a slightly different report. For us right now, the main thing I wanted to show you there is these are the yields. You're going to get some odd data. Yeah. You'll get the odd one that's a bit strange, but generally, these are the high. Interestingly, some of these highest yielding areas are not the cheapest. They're the most expensive parts of the UK. Yeah, so just bear in mind that it's not always the cheap stuff that you need to buy. But in amongst this, you'll get some cheaper areas, some more expensive areas. But you want to be buying in these sort of 6% yield and above areas, and you can see there's lots of them. There are many postcodes that you can invest in, and that data is just there, and that's updated every month for you. So you don't need to worry about it going out of date. This is an example for me. Earlier, I was looking at the highest yielding areas in Swansea and the highest yielding property types. And the highest yielding property type in Swansea is a 1-bedroom flat in SA1. And then they're £110,000 to buy. And then the next best yielding is a completely different part of the city. It's again 1-bedroom, but you can buy them for only £80,000. So most people will be obsessed with the cheap stuff, but actually you can spend more and get the same yield. So do you need to always shop in the cheapest areas? You can spend a bit more. In that instance, they're probably about 30% more and get the same yield. So maybe that works better for you if you're doing sort of more premium type refurbishments. That area might lend itself more to it. So this is easy. This is child's play now because we've got all of this data. I can tell you exactly how much it's going to rent for, exactly how much I could be buying it for. I can tell you comparable areas if you want to get a similar yield. I can, if you've only got £90,000 to buy a property, you can buy them there. If you're not really worried about cost, you can buy a 3-bedroom property in SA1 as well and still yield well. So there's lots of ways of playing about with all this data, and it's all within this software. But I feel like I'm getting a bit sales pitchy, so I'm gonna stop trying to sell. I just wanted to show it to you. Thank you for the question. Really appreciate it.
Aarti, and thank you, John. I just have one, actually 2 questions. So the first one, can you hear me, John?
Yeah, I can hear you. Yeah.
So the first one that, as you said, that this platform is just for UK for now. So is there a plan to go further in future, like Europe countries or any further?
Yeah, there is. We've definitely got a plan for it. We have a lot of learning to do, and I'll be honest with you. I mean, this business started. We started scoping and wireframing this business back in. It was actually about 12 months ago, September last year. So we've kind of this is the proof of concept. The UK was the proof of concept to show that it works. Then we plan to expand out to other areas, particularly around Europe. We are looking at the US market as well, and also some of the Australia is reasonably similar market to the UK, so we're looking at that too. What we do need to do that though is we do need to look at basically raising funds for the business to go out to those areas and look for partners in those areas. So there's a bit of work for us to do on that before we do it. But ideally, in an ideal world, I would like to think that we start gathering that data in different countries in the first quarter of next year. So we're about 2.5 months off starting that. And if anybody wants to be involved in that or get access to that data, just drop me a line and let me know. Or if you know of anyone who can help with that, please let me know as well.
Sure. Thank you so much, John. That's really helpful. And the other one, I saw that we can track our progress for further the status of that particular property, or if we put an offer. So is there any arrangement where we can have the follow-ups tracked as well? So like how many times we have done our follow-up, or because
brilliant question, brilliant question, and important as well. Yeah, absolutely. So you can, if you go to Deal Analyzer, you can look at that deal that I just found a moment ago. I can view that. If you want, the software knows that I've made some offers on that, but you'll also see just here, where hopefully you can see there's some tasks. So I can add a task in. So you can say I need, I don't know, follow up with agent. Oops. Excuse my typing, and then I can put some detail in, and I can say when I need to do that by. So I need to do that on Friday this week and save it. So that will now know for that property there's a task, and you can see it's there. Follow up with agent, but also because you're going to have lots of these, they need to be consolidated into one view. So that one view is all delivered in your calendar. So if you go to your calendar, you will see, you should see on Friday, I've got a task to follow up with the agent. But the software does a lot more than this. You can also manage your own properties that you've already got. You can also put in when your gas safety certificate, your energy performance certificate, your mortgage is due for renewal. It can track all of that. And you can see in this example version that I've got now, I've got some things that are relevant to my portfolio. So I've got to get an EPC and my mortgage, when my mortgage end is. I've also got some stuff to do with trading. Actually, no, I don't. I haven't put anything in. But that could be, follow up on a mortgage offer. And then I've also got the one that I've just put in there, follow up with agents as well. Plus all the stuff that's expired, stuff that's already happened. So things like viewings, portfolio trading, check some land, go to a networking event, deal with a property sourcer, go on a study tour. They're all in there. So you can track everything. And it'll remind you every time you log onto the software, it'll say, today you need to make sure that you follow up with the estate agent. It'll also say you have a mortgage due in 4 months, and you may want to contact your mortgage broker. You can do all of those things. You can use that as much or as little as you like, but it's all embedded in the software.
Yeah, perfect. So yeah, really, really brilliant, because I was searching something like that to keep, our task plan in somewhere.
Yeah.
We use our calendar, like Gmail calendars and stuff like that. But this is really brilliant.
Yeah, it's nice to have it all linked together, because if I find a property and I like it and I want to do something with it, sometimes I'll say, follow up on this property. You can see there, I've got some follow-ups on properties. So I'm too busy to deal with it. So I quickly go on the app and I go, like, just put that for follow-up in 2 days' time, and then I can follow up on it. So because I don't like using lots of different pieces of software, I don't like, your task management, then your diary management, then you're searching for properties, then your data around the property industry, and then, your affordability, all of that. They're all different places you've got to go. And as I said a moment ago, for me, my world, all I want to do is check the market with a cup of tea. And then if I like it, I'll go and act on it later in the day when it suits me. And then I can save and track everything that's happened. And, the speed of search is a big part of that, being able to search really fast, but also having access to the data that nobody else has. So even just something as simple as, how are my areas performing this month? In the old days, I had no idea whether or not my areas were performing well or not. I'd have to go and sit down and spend 2 days analyzing. But here's all my areas. These are all my areas. There's 10 of them. I've got them all in my dashboard, and I can see what's doing well. You can see all of them have had a drop in demand, so they've all gone red. But there's still areas where you've got really good rent inflation and really good price inflation. So I've got that. I can also see how they compare to other areas. I can even check the properties that I own. I've only got one of them in here for test, but you can put your whole portfolio in. And if you put your whole portfolio in, the software will remind you when certain things are due. It'll give you information for your mortgage broker. It'll give you information in terms of what you should be renting it for. And then you can add things like, should you get a new mortgage deal? Does your gas safety certificate need doing? Have you got to update the fire alarms? Have you got an electrical certificate to do? So yeah, there's all the information about that property underneath as well. So what are the current asking prices? They have current asking rents for that property that I own, even the estate agents. So yeah, I'm sorry, folks. I'm turning this into a training session for my software. It's easier for me to answer the questions by showing you rather than telling you. So I'll stop. Sorry, but thank you very much for the questions and giving me the time to answer them with the software.
That's brilliant. Thank you, John. I mean, that's the ultimate goal for every investor, to have the quick the data that is gathered, and then we can take the quick decisions as well. So
yeah, I'm so glad you asked the question. Thank you for doing so, because it shows that we're providing the solutions to the problems that we've all got as property investors. It's lovely. I've got an idea. I think I know what we want, but to actually hear what people want and then be able to show you that we've got a solution for it is fantastic. So thank you for giving me that opportunity.
No worries. Thank you so much, John.
Thank you.
Perfect. Thank you. So if no more questions, then I'll hand over to Robin again. Robin, over to you.
Thanks, Kushal, for assisting with this session. And once again, a very thank you, John, for coming in for this particular event, and with the help of Jitos. Jito is a key person for us to be to bring you in this particular event. So once again, thank you, Jito, for that. Along with that, all other participants who have joined this evening, and also as you know that this event is being recorded, and it will be in our YouTube as well as in Facebook page. The other participants who would like to watch will be available as a recorded, available for them to watch in near future. Once again, thank you everyone, and have a very good evening. Bye.
Thank you, everybody. Take care.
I just forgot to mention, we have our next session in the month of November. Please do join, and in meantime we will be sharing the details of the next guest, as well as along with the time and date and time for the month of November. Thank you, guys.
Thank you.
Thank you.
Thank you, everyone.